Hi, thank you for joining Dolfin's March Investment Update. We're going to spend 20 to 30 minutes talking through some of the February performance, the impact on our models of the outbreak of the coronavirus, and a little bit about our positioning at the end of the month. At the end, we'll circle back and talk about our looking forward strategy. Just in terms of looking straight up at performance, we were not anticipating the outbreak of coronavirus that has spread throughout the world over the last 4 to 6 weeks. However, based on valuations and underlying company fundamentals, we were incredibly conservatively positioned with equity exposure ranging from 1.5% to 2% up to 3.5% across all of our models. What that means performance-wise, obviously the conservative models were outperforming given some of the falling bond yields that we've seen across markets and across the curve, and the lack of equity exposure resulted in most of our models generating very good performance on an absolute return basis, which is the focus for many of our clients. We've listed the monthly performance where our best performing model was the conservative dollar, which returned 90 basis points, even on an absolute return basis. That's very good for our clients, seeing some of the volatility. In the last week of February, when we saw a nigh on 10% decline in the equity markets, we saw that filter across to approximately 10 to 13 basis point pullback at a model level. So we've been very comfortable with our positioning throughout the month. We've avoided a lot of the volatility. We've sort of listed down some of the equity market movements, and we've been happy to avoid the drawdown. Obviously, the most important thing from our perspective is to make sure that we're positioned comfortably going forward. We've not made any changes in terms of adjusting equity exposure in February, and we continue to remain positioned in the same way in March. For the next 15 to 20 minutes, we're going to talk a little bit about the spread of the virus, the impact that that's had on equity markets, specifically looking at some of the sectors. Jeff is going to talk a little bit about some of the movements that that's had on the fixed income market, and James is going to talk through initially partly virus and partly some of the supply side issues that that's causing. So I'm just going to pass you across to James.
Thank you, Simon. What I'd like to do is start by talking very briefly about what's happened and how these events have manifested themselves in the financial markets and why this is particularly significant at this time. At the end of December of last year, in 2019, reports first started emerging of a new virus in China. Initially, there was very little alarm or even attention that was paid to it in the financial markets. But by the 23rd of January, the Chinese government was sufficiently concerned that they began to implement some very significant and dramatic quarantine measures in order to bring the virus under control. Without going into any detail as to what exactly the Chinese did to make this happen, suffice it to say that they were very severe and in some cases perhaps harsh measures, but they ultimately proved successful, at least to this point in time. It's unclear as to whether or not, when the Chinese workforce fully returns to their place of employment in coming weeks and months, whether we will start to see a return of fresh coronavirus cases. And it's also unclear as to whether the success that the Chinese government has had with their severe quarantine measures can be replicated outside of China and thus bringing the coronavirus under control. As you can see from the chart that we're showing you, the spread of the coronavirus in China has largely abated, and we have now entered into the severe stage of acceleration outside of China in the West, and starting to see cases breaking out in Latin America and Africa. The financial impact of the coronavirus was not really felt outside of China until the weekend of the 22nd, 23rd of February, when a cluster of cases was discovered near Milan in Italy. Markets opened up that Monday very bearishly, trading sharply lower. And over the next week, the US stock market, the S&P 500 in particular, recorded its swiftest 10% correction in history. And this is something that I'm going to be repeating several times over the course of the next few minutes. A lot of the movements that we've seen in the financial markets are unprecedented. And this has caught a lot of people's attention. Over the following days and weeks, we have seen the virus continue to spread, and there is as yet no sign that it is leveling off in the West or the rest of the world outside of China. Following the initial sharp sell-off in US equity markets, there was an expectation that built in the financial markets that there would be a policy response, particularly out of the Federal Reserve. This was realized on March 3rd when the Fed made a very unusual policy step. They cut the benchmark lending rate by 50 basis points. This is in between Federal Reserve meetings, and they made the announcement minutes before the market opened. The initial response was not positive. Markets had already priced in a Fed cut, and when the Fed cut arrived, I think many people started to re-examine whether or not the cut was sufficient, whether it would be effective, and whether or not the Fed might know something that the rest of the market didn't know. The market continued to fall despite other central banks following the Fed's lead, and we are now looking at another 50 to 100 basis points as priced into the Fed futures in the next meeting in March. If we could switch to the next slide. Manufacturing PMIs have only recently come out for the month of February, and in China, where the slowdown occurred before the rest of the world, what we've seen is an unprecedented drop in Chinese economic activity. The pace of the slowdown in Chinese manufacturing output is steeper than was even seen during the 2008 global financial crisis, and it occurred all at once. To put it briefly, the Chinese government has attempted to solve the coronavirus problem by bringing the Chinese economy to a momentary standstill. And this is something that we've never really seen before. PMIs measuring economic activity or manufacturing activity outside of China have held up relatively well for the month of February, but we think it extremely likely that for March, we're going to see significant negative economic performance globally, so that the kind of slowdown that we've seen in China to some degree is going to be replicated. As a result, what we have seen is a very significant risk-off move in financial markets. And in some cases, these have been, quite frankly, extraordinary. What I show you here is the very long-term history of US long-term bond yields, going back to 1870, which is about as far back as it's possible to measure bond yields. And as you can see, the US Treasury benchmark has never fallen below 1% in history. In fact, 2% has always been a bit of a floor for the long bond. But over the past few days, 10-year yields on the US Treasuries have sliced right through that floor and are now trading at around 65 basis points as we sit here right at this moment. This is truly unprecedented and has been replicated throughout the fixed income markets. The 30-year has also reached record lows. Gilts have reached record, yields on gilts have reached record lows. So it is a global interest rate response. And it's not been confined to the Treasury market. So credit spreads, both for investment grade and high yields, have spiked. They haven't reached the kind of levels that we saw during the global financial crisis, which would indicate severe stress. But the fact that they have moved so abruptly is an indication that the markets are very, very concerned that such stresses could ultimately appear. Implied volatilities are an excellent way to measure the extent to which markets are worried about future events. And the moves that we've seen over the course of the past week in both the VIX, which is a measure of implied volatility for the S&P 500, the US stock market, and in Treasury implied volatilities has been extreme and dramatic. These implied volatilities are sending a very, very clear flashing red light that markets are buying protection and are very, very concerned that there's further downside potential to come. The initial move in the financial markets was in commodities, particularly in oil. And the reason is because the expectation of the market has been that there's going to be a severe disruption to what I would like to call discretionary communal activities, travel, non-essential travel, and that this is going to hit transportation demand, and thus oil demand has now been marked down to about flat year on year, which would be the weakest oil demand growth that we've seen since 2008. So in many ways, these moves which we have seen are in fact unprecedented, both in terms of the degree to which financial markets have responded and in terms of the speed. We have not yet seen the kind of financial seizure that we saw at the depths of the 2008 financial crisis, but I do think it is instructive to think about the kinds of mental models that people in the financial markets are using right now to understand where we are today. Market participants, they're very fond of using the alphabet of market downturns. So we like to talk about V-shaped, W-shaped, U-shaped, or L-shaped downturns. And that helps us to visualize and understand the speed and the extent of a recovery. A V-shaped downturn is one which is very brief and from which we recover almost completely. A W-shape is much more volatile, but there is a recovery that happens in good order. U-shapes mean that there's an extended period of low growth, poor economic and financial performance before there's finally a recovery. And L is there's no recovery in the near term. And these can be very instructive in helping us to understand whether we're dealing with a supply shock or a demand shock. In the initial stages of the coronavirus epidemic breaking out in China, we were facing a supply shock. This meant a disruption in the global supply chain. This meant that Apple, for example, was going to have trouble sourcing components and thus was going to have trouble meeting iPhone demand. A supply shock like that is usually V-shaped. There's usually a quick recovery from such a disruption as supply chains are rebuilt and are mended. Conversely, a demand shock is much more pernicious and difficult to resolve. The way of solving a supply shock is essentially by working harder. So thus, a supply shock has its own resolution built in. The way of solving a demand shock is by effectively consuming less and saving more in order to rebuild balance sheets. Thus, a demand shock does not have its own resolution built in. There's generally an external source that needs to be applied. That's typically a stimulus that would come from policymakers. And this is very troubling at the current time. Interest rates are at historic lows, as we've just seen with the US Treasury. And as the Federal Reserve has been quick to introduce rate cuts, there isn't that much more room that the Fed can go. Likewise, rates around the world are even lower than they are in the United States, again suggesting that there simply isn't a lot of scope for monetary policy to provide a tremendous amount of support. There are also questions as to the effectiveness of monetary policy in the current environment. Providing more liquidity is not going to solve a supply shock. It's not going to resolve supply chain disruptions. providing financial excess liquidity can be helpful when you're facing a demand shock, if it inspires people to consume more. But if people simply try to consume iPhones that can't be sourced because of the supply side of the equation, then it's all for naught. Similarly, on the fiscal side, there's a limit to how much stimulus we think can be provided to the market in the current environment. The US federal deficit is running at about 4.5% of GDP, which is typically the kind of level that you would see in the US at the bottom of a recession. So when tax receipts are low and countercyclical spending on unemployment and benefits is very, very high. At the moment, the US is running a very substantial deficit when the economy is running at a very rapid clip. So there's not a whole lot of scope for the government in the US to increase fiscal spending as a way of cushioning the blow. Thus, if this supply shock that has emerged from the coronavirus epidemic turns into a meaningful demand shock and then morphs into a credit squeeze, which causes a wave of bankruptcies, defaults, layoffs, then we may not have the tools in order to resolve the situation. Finally, the coronavirus is coming at a very difficult moment in the global business cycle. China and Europe have been showing signs of recovery from weak growth in 2019, largely due to, in part due to the impacts of the trade war with the United States. But they had been showing some signs of recovery. That now looks to have been quashed, at least in the near term. The United States had been running very, very strong, but the US growth was largely supported by the easy fiscal position of the US government in 2017 and 18, and the easy liquidity that had been provided by the Federal Reserve. As the impact of those stimuli have waned, the US economy has also been showing some signs of weakness at the margin. So as a result, in the fourth quarter of 2019, there were some concerns starting to emerge that growth in 2020 may not be as robust as you would hope. That's the backdrop against which the coronavirus has occurred, and it means that we're in a relatively poor position to cope. It's extremely difficult to say what happens next. When I talk to people in the financial markets and in the community, there's a lot of attention given to what kind of a level might be appropriate for stepping in and buying the dip. And my thought on that is that it's really not about what sorts of levels at this point you would look for, it's rather what sorts of events. And until we have a clear sense as to the earnings impact of the supply disruption, until we have a clear sense as to the extent to which the slowdown in economic activity in response to the epidemic is going to impact the global economy and corporate balance sheets, it's going to be very, very difficult to then calculate what kind of valuations would be appropriate in the fixed income and in the equity markets. I think the crucial questions that we face right now are when will the virus come under control, and whether or not governments and central banks are going to be able to prevent a wider liquidity crisis. Once we have a sense as to those two factors, then I think we'll be in a better position to understand where the markets are likely to head in the coming months.
Thank you. Just to look a little bit more at how not just the increase in the number of cases of the virus, but also to sort of graphically demonstrate how the markets have pulled off. On slide 8, we're sort of looking at some of the broad-based indices. What we've been looking at is partly how our single stocks sitting within the models have been faring versus their relevant sector, but also looking at how the indices have been performing. Obviously, the notable exception has been China having been beaten up a little bit in 2019, which is sitting positive on a year-to-date basis. I'm not going to spend too much time going through the equity side because we're going to come back to that a little bit later. What we did want to highlight on slide 9 is it has been a very broad-based sell-off, looking at S&P on the left-hand side and the European sectors on the right-hand side. We have had selling across the board. We've seen the utilities and some of the defensive sectors which have been impacted slightly less. But what we've seen to date is not necessarily what we're going to see on a going forward basis, and more importantly, on a recovery basis. So what we're focusing on today is what has happened in February, where we are today, and a little bit about what we could see. But this is going to be dramatically different to a deployment strategy when we're looking post coronavirus, post the peak, and actually how we can try and position the portfolios to benefit when we do start to see revenues and earnings going up on the company side. Energy has been incredibly negatively hit, partly because of the, as James was saying, underlying energy prices, but this is also reflective of what Jeff will mention a little bit in terms of one of the reasons why we repositioned our high yield exposure in the run up to the end of 2019 away from the US and into European high yield. So on that note, I'll just hand across to Jeff to talk you through a little bit on the fixed income side.
Thank you, Simon. And just to reiterate our portfolio performance, as Simon mentioned at the beginning, our beta allocations by geography in fixed income have turned out to be winners through February. In rates, the US outperformed other regions, and in credit, Europe outperformed. Market performance in fixed income was broadly moving in the same direction as we saw in January, with both US and UK government bond yields moving lower and risk assets being dumped by investors. But the move has only been even more pronounced than the previous month, with virus fears spreading outside China. Once again, our underweight position in US Treasuries has allowed us to capture the rallying rates. Now, James has already mentioned the collapse in yields in Treasuries. I just wanted to recap a few points as it pertains to that portfolio. Last Friday, Fed Chairman Jay Powell delivered a statement indicating that the Fed is monitoring the virus situation with very similar language that echoed sentiment that we heard last summer before the Fed made a series of cuts in response to the escalating trade war. And it was at this point that futures markets moved and predicted an imminent rate cut. And we didn't wait very long to see an emergency rate cut in between Fed meetings. That was the first of its kind since 2008. And that decision blindsided investors. And we've since seen an unprecedented collapse in yields, with a 10-year Treasury reaching an all-time low of 70 basis points and a 30-year Treasury touching 1.25%. The market currently expects a further cut at the next Fed meeting on the 18th of March. And at this point, we think the Fed will do whatever it takes. And compounded by the increasing number of reported virus infections in the US, our base case is for further yield pressure and bold flattening of the curve. And separately, I wanted to highlight that at Dolfin, we have a tool available to clients that allows for bonds and ETF selection, and also the plotting of yield curves, as you can see illustrated in this slide here. So please reach out to your relationship manager if you would like more information on how to use this. So the sell-off that we saw on closer inspection, it was the deepest weekly drop that we've seen in high yield markets since 2011. We've observed it to be a sell-off that was led by cyclical sectors. Now, we've tried to frame this impact into 3 buckets to help us understand what a rebound could potentially look like. Now, first, there are the sectors with direct revenue exposure to lower consumption and less travel from Chinese nationals. Secondly, there are the commoditized sectors affected by lower basic material demand and also lower global growth expectations. And then finally, there are these industry groups with supply chains that are deeply intertwined with mainland Chinese manufacturing bases. Now, unsurprisingly, the worst performing sectors in the credit space were gaming and casino, energy and chemicals, and also automotive and the retail sectors. Now, at the other end of the spectrum, traditionally defensive sectors, including healthcare and utilities, have remained resilient, But home builders and real estate have also benefited from this lower interest rate environment, as we're expecting to see favorable mortgage refinancing, which will also help out consumers' pockets. Now, in this lower rated credit has also underperformed in the sell-off versus higher quality credit. And we've also seen record outflows from active managers. So we may potentially see the more liquid BB rated bonds actually selling off further in a bid to liquidate positions. And then finally, touching upon what Simon had mentioned earlier, in September, we switched out from our US high yield position into European high yield to reduce our portfolio exposure to energy and metals price volatility, especially for CCC rated companies with that type of exposure. And that's played in our favor with the recent declines that we've seen in Brent and copper prices and pricing of other baskets of metals. Last week, we also saw primary markets grinding to a halt amidst market volatility, both in investment grade and high yield. The only high yield issuer that braved the market volatility was Cleveland Cliffs, which sought to refinance AK Steel bonds as part of its acquisition plan. And in the very end, they needed to abandon the unsecured tranche of the deal amidst strong investor pullback. Now, the sentiment of corporate issuers has turned around since the Fed cut its rates by 50 basis points, and investment grade deals flooded back to the market to take advantage of the low yields. But despite this improvement in market sentiment, and also despite the very attractive valuations, we're still very cautious of jumping back into credit because of the uncertainties surrounding coronavirus that James has already mentioned. And with all of this dispersion in the market, it calls for an approach for prudent sector allocation by fund managers, and also deep fundamental analysis into single names to accompany that approach. And instead of trying to catch that falling knife, we prefer to find dislocations in the market and allocate to defensive sectors, but achieve a comparable yield through increasing our duration or going down the capital structure in names of solid balance sheets and minimal exposure to the virus. In essence, we prefer to take financial risk over operating risk. And we currently have a preference for longer duration healthcare credits and also longer duration utility bonds in the crossover BBB and high BB space, where we see most value.
Thanks, Jeff. Just switching back to equities. We did, as I mentioned a little bit earlier, we're incredibly conservatively positioned, sitting on this split between core and satellite equity positions. We came into 2020 with our core equity exposure at 0. As I said, this was nothing to do with concerns on the coronavirus, but more to do with company valuations. Our view was, with the S&P 500 trading on P's of 19.5, that valuations were incredibly stretched. We were already seeing 2020 earnings being guided lower by companies, and we weren't confident that we were going to see the revenue growth to deliver the earnings growth to justify the multiples that we were trading on. We ended 2019 with a lot of our models between 11 and 15% over the course of the year. But with our focus on absolute returns, we weren't trying to chase the markets higher into year end. We were trying to be comfortable with our own positioning. This meant that when we did start to see news of the virus spreading, we didn't have any core equity exposure to trim. Since the 11th of February, which was when our first internal meeting focusing on the concerns of the virus and the impact that this could have on the global economy, we were sitting with 450 non-China confirmed cases of the coronavirus. Our initial concern was, as James mentioned, the supply side, and now we're looking at how quickly this is going to transition across to the demand side and potentially the longer term implications of that. So whilst we have seen some retracements of equities, and we've already seen some central bank action around the world, we do believe that there is more potential for equity markets to correct, even when we're looking at purely a valuations perspective. We're still looking at valuations on both the S&P 500 and the MSCI emerging markets that look a little stretched. So from our perspective, when we're looking at core equities, we have no interest at current levels in trying to build up exposure. Now, the positive kick through from both the duration positioning that we're holding in our models, the lack of core equity exposure, the only equity exposure that we have is sitting within our single stocks, within our thematic ideas. The performance benefit that is seen year to date is our current estimated performance means that 8 of our 9 multi-asset global models are in positive performance year to date, with the sterling and dollar conservative both up in excess of 2%. Whilst we're happy with the positive start to the year, we are looking at how we can deploy both from a duration and yield curve positioning perspective, any additional individual names that we want to include on the thematic side, as well as at what point and what triggers we're going to use to build core equity exposure back up in our models. Just looking a little bit at the thematic baskets, we have seen all 4 of the main genres pull back. That's not unexpected given the focus on emerging market consumers that does fit in and sort of spreads across a lot of the themes. One of the primary areas that we've been focusing on is video games. We've seen a lot of evidence coming out of China and increasingly other countries when they have been either self-imposed or government-imposed quarantines, that the number of video game downloads and gaming time has increased as people are confined in their houses with limited entertainment options available to them. So this is one of the ideas that we're exploring going forwards. Just in terms of looking at the individual stocks that we have, 2 out of the 3 of them are specifically focused on gaming. So EA and Tencent. We've listed our performance just so we can be as transparent as possible, because as with almost every equity in the developed market, it has suffered considerably in the last 2 weeks. But because our position totaled between 2.5% and 3%, that's fed through in a very, very limited impact at a portfolio level. Now, the last thing that I wanted to follow up by saying is that a lot of what we've been talking about is where we've developed to so far. The fact that we haven't had any adjustments in the portfolio to make because of the coincidental positioning from a defensive perspective. We've been talking a little bit about hitting record low bond yields, some of the fastest negative equity markets that we've seen, and that's taken us to where we are now. What we're looking at and what we're going to be discussing next Thursday at the same time is the outline of our strategy going forward. What we're looking at is which particular sectors and which individual stocks within those sectors we believe are going to be positioned in the best way to allow us to time to some extent when we want to take exposure and where we want to take it. What we're not going to be discussing is the actual time of redeployment into the markets, because as James mentioned, that's currently too early to have any sort of indication. It could be weeks, it could be months. What we are confirming and what we will be laying out is our initial thoughts, some of the companies that we're looking at, some of the sectors that they're operating in, and why we believe this is going to be an interesting way to play potentially the second half of the year. But at the moment, we're remaining in a wait and see mode, and we will be continuing to monitor the markets closely. Thank you for joining us.